there, Pat Struby, founder of Preservation Specialists, here today with a timely announcement related to current interest rates. John Matthew and I were recently at an investment conference together, and like many of those, there were a lot of presentations and discussions related to the stock market and the economy, and of course, the upcoming elections. In addition to those topics, the biggest takeaway we all had was regarding interest rates. At this moment, inflation has recently been cooling off, and Fed Chairman Jerome Powell has suggested they will begin dropping interest rates later this year. While none of that is probably likely surprising news to you, we felt one of the speakers made a really interesting point. He compared the current situation to mortgage rates back in 2021. You see, if you had a mortgage at that time and you locked in your rates, you could have locked in a 30-year mortgage as low as incredibly 2.65%. And I don't know about you, but whenever I think of numbers like that, I always think of my first mortgage rate, which was 7%. Obviously, a huge difference. So locking in a mortgage rate in 2021, if you had a sizable mortgage at that time, could provide you with a huge savings on the interest you owe. The comparison made at the conference was that the same could be true of locking in rates on your savings and investments over the next few months. While no one knows what interest rates will be in the future, the Fed periodically provides its best estimate, and as you'll see in the chart we'll provide here, the Fed expects rates to drop by 2% over the next 2 years. So that means if you're enjoying a 4% interest on a money market account right now, that rate may be cut in half over the next 2 years. So our advisor team believes this is an ideal time for us to review your accounts and see if it could be beneficial for you to lock in rates of any kind. This could apply to many different types of situations. And while this list isn't complete, we put together a few ideas for you. So the first one is that first one I mentioned. If you currently have money in a savings or a money market, now is a great time to consider how much of it you need to have immediate access to. And maybe that's all of it. But for example, let's say you want to have $50,000 that you can access immediately if you're a retiree and you have some kind of emergency that you need to spend on. But let's say you've accumulated $100,000 in savings. Well, maybe we should take that difference and consider locking that in. And that could be something as simple as a CD, or maybe locking in a fixed rate annuity over the next 3 or 5 years. A second idea, if you have benefited from the stock market increases over the last 4 years, this may be a time to consider taking a chunk of those gains and transitioning it into something with fixed rates. Of course, no one knows the stock market's future, and it could continue to go up significantly. But as I mentioned in a recent commentary, Schwab's recent market analysis shows that the markets are currently overvalued. So that doesn't guarantee any kind of market drop at all, but it's just something we want to consider when we're thinking about where your money is. And then a third idea, if you have an annuity that was issued when interest rates were very low, we believe this is a really important time to do a review of your annuity. Our current analysis shows that some growth rates and even some income payouts could be substantially higher now. While we usually seek to help you avoid fees in all cases, this is an unusual rate environment, and it could be our best opportunity to lock in the best terms possible. Therefore, we think this may be an extremely unusual situation in which it could actually be beneficial for you to pay a penalty now to improve the terms of your contract. Allow me to explain in a little more detail. If you allocate to a long-term annuity, such as 10 or 12 years, the annuity company is investing your funds for the entire term up front. That means if interest rate increases during the term, you don't necessarily receive higher gains during that time. On the other hand, if current rates are the highest we'll see in a long time, it could be an ideal opportunity to lock in long-term annuity rates. As an example, some annuity companies now offer both 7 and 10-year options. In my most recent update meetings with clients, we have opted for the 10-year option, as we believe we want to lock in these current terms as long as possible. Our advisor team is working to review your accounts, and if we believe there may be an opportunity to look at something that could potentially be to benefit to you, our office will reach out to you as soon as we can. We want to make sure we take advantage of this window if rates change sooner rather than later. So because of this, we may suggest an initial phone call instead of a full in-person update meeting. If you have an annuity that we plan to pay income in the future, your advisor will likely ask you to estimate when we might want that income to start. You won't be held to that time frame, but it's allow us to have an apples-to-apples comparison for our call. If you have funds that aren't managed by preservation specialists and would like to discuss them with us or learn about potential solutions, of course, please don't hesitate to reach out to us. While it may not be the same as locking in a 30-year mortgage, we hope we can assist you in generating better returns for the future by making smart decisions today.